Hello and welcome. We've just heard the Federal Reserve has cut interest rates by 0.5%. Welcome to Moomoo's webinar on unpacking what the rate move means. We're joined by Justin in the US and Michael McCarthy, who's here with me in Australia. Michael is Chief Commercial Officer in Australia, and Justin Zacks is standing by. He's our VP of Strategy in the US team. But first, let's just get to some housekeeping on how today's webinar is going to work. We're going to unpack everything you need to know based on what the Federal Reserve and the Jerome Powell chairman, or rather the chairman of the Federal Reserve, has just announced, and what it importantly means to you and your investing and trading strategies. That'll take us through about 25-30 minutes, and then we'll be answering the questions that you've sent in. So thank you to those of you who sent in your questions in advance. We'll also be taking questions live, so we'll encourage you to send your questions in, and we'll get to those at about the halfway mark. But without further ado, let's just hand over to Justin now. Justin, we want to hear your take. What are your initial thoughts on the Fed's larger than expected 0.5% rate cut? We saw markets initially 1% up before the Fed made the decision, and then after the chairman spoke, we saw markets take a step back. Take us through your initial reaction and what this means for the US market and beyond.
So I think you've seen a lot of uncertainty even before they made their announcement. In the past few years, the Fed has been almost expert at telegraphing exactly what they're going to do, whether they would cut or not, and how much they would cut. But going into this, I think there was a lot of people that were looking for 25 basis points, and there was a lot of people that were looking for 50 basis points. And it ended up being 50 basis points, but you obviously did see a dissenter. So this is the Governor Michelle Bowman was the first governor to dissent since 2005, and this is the first dissent in the FOMC since 2022. So that was kind of a big deal to show that not everyone was aligned with it. Some people only wanted to do a 25 basis point rate cut, and everyone else kind of went along with it. But there's this idea that they want to kind of get this front loaded, that they are starting to worry a little bit about unemployment. But overall, the chairman in his press conference said the economy's fine, and when you look at this cut, you have to look at it holistically. It's the start of a cycle, and they're just kicking it off with 50 basis points. There will be more cuts to come, and so if they only did 25 this time, there's a very good chance they would have done 50 in November or December when they meet again. They're going to meet twice before the end of the year, and if you look at the projections of the Fed members, about 10 of the 19 officials expect 2 more cuts, and then 9 of them expect 1 or less cuts going into the end of the year. So not as many cuts as people thought, but they just did 50. So when you add that all up, again, that's a lot of uncertainty. A lot of the governors themselves are not on the exact same page, but in getting there at the end of the year, they're much more aligned. And so you saw initially 50 basis points, you would expect the market to run up, and that's this hot money coming in. But I did think you saw a lot of people position going into this. Market was close to the all-time high in the stock market. The bond market yields had come down tremendously in both the front and the long end for the last few months. So when you look at all that, you really go into an idea that it was already positioned for a 50 basis point cut, even though it wasn't necessarily 100% expected.
Yeah. It is really interesting to see the markets react, but I think for the most part, the Fed did make it pretty clear that we're going to see about 2% of rate cuts, and that was somewhat in line with what the market was expecting. But we've just brought up your chart here on the impact of previous Fed rate cuts and what it's meant for the stock market. Just take us through that and what you also see ahead in terms of potential volatility maybe coming down.
Yeah, and I think that's, exactly, you can take what happened today as a microcosm of the whole cycle. So when you look at when they do a rate cut, everyone thinks, well, this is good for businesses. They're lowering their cost of capital, and so we should just go out and buy stocks. And that's the initial reaction a lot of people are going to have. But it's not necessarily true. What you do see is, more often than not over these past cycles, we have seen, a positive reaction a year later. But there have been situations where you don't, because a lot of times they're cutting rates for a reason, and that reason may be a economic slowdown or a possible recession, or a pandemic like the last time we had one. If you look at the last three times they kicked off a rate cutting cycle with 50 basis points, that's 2001, 2007, and 2020. So those were the last kind of ones that they've done that. And so that's also something to think about. Like, and that's why people may be a little bit afraid. Well, like, why are they going this big to start? Because normally they would go a quarter and then continue with a quarter. But I think there was this feeling that they might have wanted to go in July and they didn't, and they want to kind of make up for it. But as you can see from this chart, there are some situations where you get into the recessionary periods, and when they start cutting initially, it might be fine. But if they're doing emergency cuts, if they're doing additional 50 or 75 basis point cuts, this is probably for a reason, and it's usually due to a recessionary fears or a severe economic slowdown.
Yeah, so we did see the FOMC's forecast for GDP come down. So that, I guess, is part of the reason why we saw more or less the bigger than expected cut. In saying that, though, about 70% of that cut was expected. But just walk us through potential volatility. So you previously said that market volatility has typically come down in prior rate cut cycles, and this will hopefully be a boon for stocks.
So, like I said, on average, a year later, we've seen stocks are up after a rate cutting cycle starts, but you can have some serious drawdowns during these cycles, even these up ones. So, the most recent one, we saw a 24% decline in stocks from the top, even though a year later we were positive. And it's some of these recessionary ones, we see 40, 50% drawdown. So extreme volatility. And it was interesting. If you looked at the market today, it's already starting to reflect it. Off the open, we saw the VIX rise considerably above 18. When you see this type of thing, it's due to this uncertainty. People don't know where we're going. And even though, if you think about it, the S&P closed down at 0.3. Not a big move day to day, yet the VIX held that level. I think it closed around 18.2. So we are seeing some people thinking there might be some increased volatility to come, both on the up and down side. And we saw that throughout the day after the 2 o'clock announcement. For the next 2 hours, we saw markets go up and down considerably. Like you said, we saw almost 1% up move and then a finish down 0.3. So we did see some volatility in there, and that's, I think, something you can expect when you have these rate cutting cycles, because there is this balance between rates are coming down, but a lot of times unemployment's going up, economic output is going down, and if this is the case, a lot of people have to readjust their thoughts on what these earnings are going to be going forward for the next year or two from a lot of these big companies.
Yeah, and speaking about that next year or two, the Horizon consensus is quite optimistic and bullish for equity markets. But in saying that, we do have, I guess, the red herring, the US presidential election in some couple of weeks. What's your quick take, just before we go to Michael for his reaction on the Fed? What's your quick take on what we can expect and what we should be aware of ahead of the presidential election and indeed after?
Yeah, a lot of people are always looking at, does does the market do better with a Democrat or Republican? But what I really like to look at is the volatility. If you look at the current VIX curve, that curve out that includes the election is elevated because they are expecting some increased volatility. And then if you look generally at where the volatility the VIX has been in the month before the election, in the last elections going back to 1992, I took a look at this and said, and basically what you saw was, in terms of actually getting elected, the incumbent party does well when the volatility is slightly lower. So it's really kind of this 20 line, right? So if the VIX peaks at less than 20 a month before, in almost every case in the past 7 or 8 election cycles, we've seen the incumbent party win. And then we saw a change when the VIX peaks above 20. And these are often, the VIX is known as the fear gauge. And what you think about is when people are uncertain, when they're fearful, a lot of times they're going to vote for the opposite party. So the VIX is something I'll be watching very closely to figure out where we are with this election, which right now is too close to call.
Too close to call, but the Fed's decision wasn't too close to call. Thank you very much, Justin. Now let's go to Michael McCarthy, our Chief Commercial Officer here in Australia. What's your initial take on the Fed's 0.5% cut and their dot plot, what it means for equities for the rest of the world?
Jess, these are key questions, of course, and thinking about investment and trading strategy in the near and medium term, there are very clear implications coming from this decision for investors and traders around the globe. Of course, with the interconnected world that we live in, any changes in major economies like the US are very important for the rest of the world as well. And of course, those effects are felt in many ways, not just in interest rate differentials, but in the way they impact currencies. And the outlook for growth for the globe, of course, directly affects commodities as well, and investor behavior. So where the markets go from here will depend very much on the reactions that we get to today's decision. So there's a lot to think about. I've just raised a few issues that I think might not be at the front of everyone's minds at the moment, just to point out we could be moving into a different central banking world. And on the table you can see in front of you, we're looking at the key factors that central banks focus on. Now, in the US, for the Fed, we refer to their dual mandate, and that is for price stability and full employment. And while the wording differs all around the globe, just about every central bank has a very similar mandate. It's about growth in the economy, it's about job stability, and it's about stable prices. And the reasons for that are social and economic. Full employment is good news both socially and economically, and that's intertwined with stability of prices. When prices are stable, both individuals and companies are able to make decisions about the future without worrying about the fluctuations or wild fluctuations in prices that might disrupt their businesses. And of course, all of this relates back to economic growth. Full employment and stable prices generally means expanding economies, which once again brings good social and economic outcomes. So these are the reasons why these factors are at the heart of every central bank mandate. And as you can see, looking at this table, central banks are now in very different positions. And this is crucial for analysing how the world may react, because since 2008 and the global financial crisis, central banks have largely coordinated their actions around the globe. Cycles of tightening or cutting have generally been coordinated. We've seen many comments from different central bankers across Asia, across Europe, and across the North Americas, where they are essentially saying the same words in their own local language. Now, looking at this table, we might be moving into a different period, and that is directly related to the factors that we're seeing here. Now, Chairman Powell was very careful to emphasise that the Fed will go fast or slow depending on what the data shows. In other words, emphasising the data dependency that many central banks have focused on in the past and will continue to do so, judging from today's discussion. So looking at this table, we can see that the inflation outlook in different nations is very different. Now, high inflation really ties the hands of central banks. They're much more likely to tighten than to cut when inflation is running well above their target zones. Although, once again, it varies around the globe, those target zones tend to be around the 2 to 3% level in most economies. With some economies like China with higher growth, a higher level of inflation could be tolerated. But as you can see from the table, that's not an issue in China. So first of all, For further cuts to be delivered around the globe, we need to see inflation at stable, lower levels and trending downward, and that's what we heard from the Fed today. But we also need to see a need for those cuts, that is, that growth is slow or that unemployment is rising. And once again, looking back to the table, there are some stark differences. And the one I'd highlight today is the difference between the outlook in Japan and that in the US. Now, the reason for that is Japan still has very low growth. And although they've moved away from their zero interest rate policy, the 10-year bond is still trading below 1% compared to levels closer to 3 or 4% around the rest of the globe. So they've got a very different starting point for their interest rates. And the reality here is that we could see, as the Reserve Bank of Australia has also flagged, we could see some central banks tightening while others cut. And that's a very different scenario than what we've seen over the last 16 years. So that will have an impact on markets if it does come to fruition. There's some reasons to think that could be the case. And if we could go to the next slide, it's a very important time to understand what your central bank is up to. Because as you can see on this chart, I've only picked out two major indices. One is the US S&P 500. That's the one on the top. The one below is the Australia 200 index. But you can see in both cases that those lines, those flat, horizontal lines, represent the all-time highs in both the US and Australia. And as Justin touched on earlier, with markets at all-time highs and the cuts in interest rates that we're anticipating very much flagged to the market, there's a potential scenario where all of the good news is already factored into the price. And of course, under that scenario, we could see corrective action in share markets around the globe, and certainly here in Australia and the US, if all of these is in fact priced in. In other words, everybody wants to buy has already bought, and if there's an absence of buyers, there's only really one way for the markets to go. So there could, despite the good news delivered today, be a period of digestion or corrective action in share markets as profit takers move in to lock in the gains that they've seen. In other words, what we could see is a buy the rumour, sell the fact scenario. And while this is not a common occurrence at markets, it is very well known that when news is coming and we have a pretty good idea it's likely to be good, all the buyers move into the market. When the news is delivered, it might be even better than expected, and yet the market sells off because there are no buyers left to hold it up. So that's something for everybody to be looking out for as we move through the next days and weeks. There could be corrective action in the markets. And of course, for some, that could be an opportunity to move further cash into the markets. That will, of course, depend on individual circumstances and is a decision for each individual. But nonetheless, there could well be opportunities coming for those who are viewing the world that way. Just moving to the last chart now, one way to gauge sentiment is between this important between the pair here, the US dollar and the Japanese yen. Now, the Japanese rates have been stable at low levels for a very long time, since 2015. And although they have recently risen, the curve has become more normal. The cash rate is still very low there at about 0.25%. And as I mentioned before, the 10-year bond only about 0.8. So we've got a very flat, low yield curve, which is unlikely to move significantly lower. So the way the market is thinking about dollar yen could well reflect the way they're thinking about US interest rates, because if further cuts are expected, we're likely to see further weakness in the US dollar. Now you can see on the chart, the vertical lines represent on the left-hand side of the chart, tightening by the US Federal Reserve, and in the middle of the chart there, cuts before tightening in the middle. And the impact on the US dollar is very clear. Although there was corrective action on the way, the stronger US interest rates and that differential with Japanese rates meant we saw rises in dollar yen. As you can see, when the Fed flagged just over 2 months ago that there could be cuts coming, that reversed immediately. And while dollar yen trends downward, some will interpret that as a sign of further confidence of interest rate cuts to come in the US dollar. And if that is the case, even investors who are not trading in currency markets might turn to dollar yen for an indication of what markets are thinking about US rates.
Wonderful. You covered all the questions that I guess investors might have for today. But just before before we cover a different picture, maybe on stocks, what can we expect perhaps over the coming months? You mentioned what we might expect over the coming weeks, but how do you think markets might unravel this decision over the coming months and maybe the next year or so?
Well, I think the chart in front of us is a great illustration of what can happen, because markets rarely move anywhere in a straight line. And as I say, in that tightening period there, the US dollar was rising quite strongly over the period and certainly finished the period higher. But on the way, you can see there was a big corrective down move. And I think that's one of the things we should be on the alert for. A change in the way that central banks are viewing the world and a change in their policy stances could see what is currently globally very low volatility creep higher. In fact, we could even see some spike events when it comes to volatility in equity markets. So it's something to be aware of. Investors should always be aware of the potential for volatility in either direction, either corrective or moving higher. And that should be a part of every investment plan. But it might also be worth revisiting investment plans at the moment to see if they are prepared for periods of potentially higher volatility in prices in individual shares and in indices.
And indeed, that's what we've seen today with volatility picking up. And just recapping what Michael has said, as well as Justin, we have seen markets take a step back today, but Michael was alluding to the fact that there could be potentially some further moves to the downside as markets really react and sell the news. So that's something to be mindful of, and also be mindful on the inverse side, while we may continue to see a pullback following on from today's move, this may also potentially act as an opportunity. So plenty of things to cover later. So keep your questions coming and we'll get to them very shortly. But I think now we might just go to some potential other aspects and some other reactions that we could expect just in light of what the Fed has done today. And what the Fed has done, I guess we've seen gold hit high levels in anticipation of the Fed cutting. And as they just announced that they're cutting rates by 0.5%, this indeed sets up a scenario that we could potentially, over the medium to longer term, see higher prices for commodities. Specifically, what we've put in front of you is gold. So we've seen the gold price trade at brand new record all-time highs. Sure, today's session, we saw gold take a tiny step lower and a touch lower the day prior, but it's been a case of 2 steps forward, 1 step back for gold. But the scenario for gold is this. If we have a look at history, which we're showing here, the last 3 times the Federal Reserve has cut interest rates, we've seen gold rally to brand new record all-time highs. If we just look at the scenario, zooming in, the last time the Federal Reserve cut interest rates was back in 2019. And then we saw the gold price march up 35% over the span of 7 months. So history, of course, never repeats itself, but it does tend to rhyme. And then if you have a look at the last 3 cuts and average out those cuts, we've illustrated that on average, gold, would you believe, has rallied 99% from the beginning of the Fed cut cycle to the peak. But if that's something that interests you, it is interesting to see that we've seen lots of investment managers really start to tilt their portfolios towards gold ETFs and also buying into gold stocks as well. So that's something to keep on your radar. And we've also seen that expressed on Moomoo as well, with some of our clients buying into gold ETFs. So what are the gold ETFs that we've seen? And why is this really worthwhile pointing out? We do know that down under in Australia, we've seen the Aussie share market actually lag gold over the past 10 and 20 years. So if you are looking for potential hot sauce to add to your portfolio over the long term, maybe consider potentially looking at a position in gold. Maybe look for pullbacks, as Michael is saying. Investors and traders often look for pullbacks as opportunities to buy into the dip to set up their portfolio for the longer term. And indeed, when we think about gold, speaking about the longer term, we do know that gold has outperformed the Aussie share market, but it's also acted as a nice cushion when we've seen the S&P 500 and indeed the Aussie share market pull back. That, I guess, negative correlation has also meant that investors with gold in their portfolio, when we've seen markets pull back, we've seen investors' portfolios kind of net sit looking a little bit pretty. So that is something to consider. If you are interested in knowing what the biggest stocks are and what we've seen investors buying into, Newmont is, of course, the world's biggest gold company. And then we've seen this company outperform the S&P 500 this year, and indeed most global markets around the world. Also worthwhile pointing out, we can see that we've highlighted the world's biggest gold ETF, and that is the GLD ETF. And that actually is one of the biggest holders of gold, believe it or not. It holds about $7 billion worth of gold. It's also worthwhile just answering one of the viewers' questions as well, that the VanEck Gold Miners ETF is another way that you could potentially look at adding gold to your portfolio. And this essentially will give you access to some of the biggest gold producers in the world, including Newmont, Angio, Barrick, just to name a few. So they're just some considerations for you. Last but not least, we think it's really worthwhile pointing out, although as we've pointed out today, on the back of the Fed's hotter or bigger than expected rate cut, we've seen markets pare back just a fraction, but it is worthwhile pointing out that the narrative is, I guess you could say, somewhat bullish, given that we do have 2% or about 2% of rate cuts expected. And that was more or less in line with what the market's broad thinking is. Now, this sets up a positive runway for supporting earnings growth. And indeed, when we think about earnings growth, we've seen the most earnings growth in the semiconductors, and that's why stocks like NVIDIA are still trading up, including the SMH, the largest chip ETF in the world. Those instruments and stocks have been outperforming the US. And I guess the narrative and the runway is quite supportive of that sector and cohort of stocks going forward. Second of all, we can see Bitcoin. We saw Bitcoin crack a fresh high yesterday in an anticipatory move ahead of the Fed's decision today. So naturally, when the Fed cuts interest rates, as Justin and Michael were saying, this typically supports innovation. It lowers companies' cost of capital. And this essentially means that we could potentially see higher prices for Bitcoin, and that is what the market's thinking is as well.
Although, Jess, I would jump in to add that Bitcoin has pulled back by more than $1,000 in trading this morning, having hit those recent highs just above 61,000 US. It's now dropped back to be closer to 60,000. So while we have reason to think the fundamentals have improved today, the question for markets generally will be whether or not that fundamental improvement has already been priced in. And of course, if it has, we could see pullbacks rather than run-ups from here over the short term.
That's a great point. And do use Moomoo's platform. We do have a lot of AI technical indicators on our platform. And indeed, this might be able to help you kind of determine how long a potential pullback could go for and when we could potentially be seeing maybe a ricochet move to the upside. So let's now conclude the first half of our presentation and unpacking what the Fed's move could mean to you? We're just going to answer some questions that have come in from users, and thank you so much to those of you who've sent them in. The first question is a big one. I might just go to you, Justin. The question is, what is the long-term outlook for interest rates, and how do you foresee that influencing both institutional and retail trading? Justin, what do you think?
I think that's an excellent question from one of our users, and I think the Fed is was trying to answer that a little bit, and it's again answer we've heard from the Fed a lot. It depends, and it's going to depend on that economic data. I want to remind everyone they cut 50 basis points, and as you said, there's this expectation for another 50 this year and 100 next year, so 200 total. But that is only an estimate, right? So you could see more, you could see less, and we're really going to be watching the economic data. And again, the Moomoo app is a great place to see all that economic data, whether that's from Australia, the US, or any other country that we have there. So you can really know in real time how the economy is doing, how unemployment's doing, what inflation looks like. So you take that type of data and you're able to analyze that to see what the long-term outlook is. And so I think it's a little easier to say the short end of the curve looks like it's headed down because we're seeing the Fed cut rates. The long end is the trickier part, and I think a lot of people are thinking, well, the long end is also going to come down, but we saw the opposite today. Obviously, if it does come down, people are thinking that is possibly because of an economic slowdown. So in terms of an investing strategy, you have to factor that in. And additionally, you have to think about, this is just a monetary policy. You want to think about the fiscal side. Again, we have an election coming up. There's going to be changes in tax policy. And so a lot of people are going to be looking at, can the U.S. come closer to balancing that budget? And they've been spending a lot more than they've been taking in recent years. And this causes them to issue more bonds, particularly these long bonds, the 10, 30-year bonds. And this is going to influence the supply of treasuries in the market. And that could send interest rates higher if there's not a demand. So I'll be looking at that. And it's a complicated situation.
There's a lot to unpack. Speaking about unpacking, our next question is a bold one. They've sent 3 questions in one, so I'll go to you, Michael, for this one. The question, bear with me, is how do changes in US interest rates affect the US dollar? Good question. Also, wait for it, how do global stock markets usually react to hawkish or dovish Fed signals, and can past trends predict this? And the third bit of the question is how to use options and other strategies to protect your portfolio from FOMC-related volatility. Great question.
Well, that's probably the most comprehensive question I've seen. There's a lot there. So I'll just touch on the highlights given our time limitations. But let's start with the impact of interest rates on currencies. And on balance, higher interest rates tend to support a currency, lower interest rates tend to see it sold down. And the reason for that is, although trade flows in currency markets are important, investment flows can also be very important. And sometimes when we see moves that confound us, we see the US dollar strengthening despite weak economic data, or we see the euro moving downward despite a potentially good outlook. It often has to do with the way investors are responding to the news. Now, around the globe, there are some key investment groups. One, of course, is Japan. And Japanese investors as individuals are the most globally mobile investors in the world. And it's another reason why a lot of analysts and strategists look at dollar yen for an indication of what investors are thinking. So it seems likely with the signals and the delivery of interest rate cuts that we could see a weaker US dollar in the weeks and months ahead as investors switch their attention away from the declining interest rates in the US to areas where they might be able to receive better returns. It does also have an impact on the thinking about the share markets, the individual companies facing higher or lower regimes. So we can see some reversing effects here. With a lower cost regime for US corporates, some equity investors might be moving into the US at the same time time, fixed interest investors are moving out. So it's not a simple picture, and divining what will happen requires some art as well as science. But overall, we do expect that lower interest rates will see a weakening of a currency, in this case, the US dollar. That's the first part of the question. The next part of the question was how will global share markets react? Well, that's the big question of the day. And frankly, none of us know the future, and it doesn't matter how much experience or how hard you work at the markets, none of us will ever know the future with certainty. So while I have a view on what will happen, I'm going to let the markets tell me. And one of the big advantages we have at the moment is we've already had the monetary side of the equation fleshed out for us this morning. Justin's right to point out fiscal uncertainty, particularly as the US moves through its election cycle. So there are some unknown factors here. But overall, if the markets around the globe, in the US, here in Australia, and the other markets that are near their all-time highs, if they can break through those previous highs, to my mind, from a technical point of view, there's a likelihood they could continue higher. If, on the other hand, they keep bumping up against that ceiling and drop away, that could be a sign of a correction to come. So rather than trying to predict the future, which I've known as a lifelong trader is a very fraught business, I'm going to wait for the price action, particularly in share market indices, to tell me what the markets are going to do. And the last part of that question was options and other strategies. Well, that's an excellent question, but one we don't really have time to deal with today. The power of options for investors is well discovered. There are some strategies that are compelling for retail investors. There are also protection strategies that are available via the use of options, but there are some aspects to that that require some study and some deeper knowledge than we can give in the short answers we'll be giving today, but I would certainly applaud any investor who invests in themselves by finding out more about options and their use in a portfolio context.
And they can absolutely do that on Moomoo's platform. All right, next question. Thank you, Michael, and thank you, Justin. Next question, gold. Is gold a good buy after the rate cut cycle started? I'll take that one.
I think that one's yours, Jessica.
So we do know from looking back at history, I might just bring up a chart for this. We do know that gold, we've seen rally to record highs. As Michael said, and as Justin said, look, naturally markets don't always go up in a straight line, and trading tends to sometimes be fraught with danger. But if you do potentially look at buying into weakness, which is something a lot of institutional investment managers and sophisticated investors do, they buy into pullbacks with a long-term view of exploring upside moves. So if you are patient with gold, remembering that we did see on average gold rally 99%. That was not over a 7-month duration. That duration was about, on average, 3 years. So if you are patient and want to stay the course, and if you believe that history could potentially repeat itself, sometimes it does, but of course history never repeats itself. It does rhyme. So you may potentially be looking at gold. Another reason for supporting gold is not just the Fed cuts. We do know that central banks around the world are buying gold, not just many other central banks in the Western world, but also China's central bank, the PBOC. And then another reason that central banks are buying gold is because, of course, with US interest rates being cut potentially, as the US Federal Reserve flagged over the coming year or so, that means the depreciation of the US dollar may continue over the longer term. And that view is why central banks are increasing their exposure to gold. With that in mind, another and the third catalyst for supporting gold is probably the fact that we do have global debt to GDP rising. Now, as Justin pointed out, with the US presidential election around the corner, we're naturally probably going to see a one-way street with fiscal spending. Governments are probably, regardless of who wins, are going to be spending more than they have the prior 4 years. So that naturally means we might be seeing an increase in debt. And this is at a time when debt to GDP is about 3.3 times the amount the average global economy or the economy is making. So there are concerns about debt rising at a fiscal level, at a big level, and also with the consumer as well. And that's, of course, why the Federal Reserve cut interest rates. So if you also believe, like a lot of investment managers, now that we could start to see funds flow into a bigger way into gold ETFs and gold companies, which is natural, by the way, and has occurred looking back at history. We've seen investment managers start to buy into gold ETFs and gold stocks after the Fed has mapped out rate cuts. So that's the final and fourth catalyst for supporting gold. No matter how you want to look at gold, there are different ways to express that. Use Moomoo's platform for inspiration, but we've covered some stocks and ETFs for your consideration. Let's go to the next question now. Another long one. How many people are saying that interest rates will increase money supply and propel the stock market? But there are also views that interest rate cuts could lead to a recession in the market. How do you make sense of this? Justin, I might go to you for this one.
Yeah, and I'd say, you have to, it's a chicken and an egg thing. When people talk about interest rate cuts causing a recession, it's usually the opposite way around. You're thinking about the Fed is reacting to a recessionary conditions or a slowdown in economic output, and that's why they're cutting rates to stimulate the economy. It's not the other way around. So what people really have to remember about these rate cycles is it takes a long while, from approximately 12 to 18 months for a rate change to work through the system. So while the Fed has been very restrictive for the last 12 months, it's now working through the system, and it's finally going to affect the real economy. And so, these real economic numbers we're seeing now are because of policy that was done, interest rate policy that was set a year ago. And so people have to remember that. So when they start cutting, you're not going to see this instant gratification. Only in certain areas. Yeah, your interest rate on your credit card is going to go down. You're probably going to get a cheaper mortgage, but overall, for the impact on business earnings, it takes quite a long while to work its way fully through the economy, and that's something I think a lot of people need to be aware of.
Thank you. I completely agree. It was also interesting to see the Federal Reserve Bank of St. Louis. Is that how you pronounce it?
St. Louis.
St. Louis. Louis. Say that. I don't know.
Well, it is in America. So.
It was interesting to see that they actually dive really deep into that. The interest rate lag effects, how long do they take? And they put together a white paper on that. And they actually found that, really interestingly, that sometimes lag effects can take up to 29 months. So really, really worthwhile pointing out that the broad thinking is in line with with what Justin has highlighted. But sometimes we need to be a little bit cognizant and a little bit aware that rate cuts, rise, hikes, they can have a lag impact of, sometimes 4 to 29 months. But let's
that's
just
a really good point. And I would add, you pointed out another really good point is there's 12 regional Federal Reserve banks in the United States, and in particular, St. Louis and Cleveland in Atlanta put out a lot of great research on their particular regional website, and it's something that users can go and take a look at and get that great research. And Jessica's already on top of it. That's great.
Well, Moomoo is on top of a lot of things. You can always type in your questions on Moomoo's platform to get what you need, or reach out to us, or indeed the Learn Premium section, and we'll hope to answer your questions. But do keep your questions coming through. Let's just move along to another really good question. This one's about potential asset bubbles. I'll just read it out. Are there concerns about potential asset bubbles or other unintended consequences that could arise from these rate cut adjustments? And what actions can we take now and even after the announcement to limit risks in the market? I think Michael's touched on some of these, but Michael, let's go to you. So potential bubbles, what action can we take?
These are real risks in the market. And the reality is that there is a direct relationship between risk and rewards. And those who seek to eliminate risk entirely will pay a very significant cost in terms of the returns that they'll get in eliminating that risk. That's just a function of economic life. Taking greater risk does open the door to potentially greater rewards, but of course it's in the name. Greater risk could also mean greater losses. So it's a decision for every individual investor where they sit on the risk spectrum. Many are risk averse, that is, they prefer not to take much risk, and they tend to use tools like diversification to lower their risk over the long term. That doesn't mean they won't be subject to fluctuations in the market. They will, but a diversified approach can often help investors ride out the tough times in markets and seek longer term positive returns. So there are different ways, and it depends very much on the individual as to how much risk they prefer and what sort of rewards and returns they're seeking from the market. But I would point out that the word bubble, or the B word as it's sometimes known by traders, is thrown around a lot. And the reality is there's been a lot of studies done over what a bubble looks like. So simply because prices have risen doesn't necessarily mean that an asset, whether it's housing prices or shares or anything else, tulip bulbs, for example, are in a bubble. But we do know the characteristics of bubbles. First of all, for us to think there might be a bubble forming, we need a sustained rise in prices that turns sharply higher. That is, starts to become close to exponential in its upward growth. Secondly, we need to see a potential catalyst for that sharp move to reverse. And generally speaking, and although they may take many different forms, we'll see what's known as a blow-off top. Now, in technical terms, as I say, these can take many different shapes, but they generally follow a pattern of a very sharp rise followed by a very sharp pullback and then a further pullback. So when we see a long rise in prices turn sharply higher, that we know that there's a catalyst, and we see a technical formation on the charts that looks like a blow-off top, then we should be particularly concerned about bubbles. But simply because the word bubble is in the headline doesn't necessarily mean that an asset is in the bubble. So once again, taking a long-term approach to investing allows investors to ride out not only the market noise, but the media noise that can sometimes distract us from our long-term investment aims.
Very, very solid answer. Thank you very much, Michael. So one of the points that Michael touched on was diversification. And I guess this goes to the next question here. Why are ETFs a good product to leverage during upcoming rate cuts? So I think that the reason why ETFs are increasingly popular is because they're easier to use and they capture broad market moves. So for example, if you were to buy the SPY, which is the biggest ETF in the world, tracking the S&P 500, and if you had a view like Michael was potentially alluding to, that maybe we could see sell the news maybe continue. If you had that view, then you could potentially buy an inverse ETF to that, and you can take inspiration on Moomoo's platform to look at ETFs for that. But why are ETFs good? Because it's essentially allowing our retail investors to express a view that a market could maybe go lower, or maybe go higher, and simply by buying one instrument or one security, it's I guess increasingly a very popular and easy way to make a potential upside and make money. So that's something to consider.
I think something we should point out here is that ETFs vary enormously in their nature, how they perform in the market, as Jess has pointed out. Some increase in value as the market's falling, which seems a bit counterintuitive, but that is the case. They're designed to do that as a hedging tool. Others increase with the market. And it's very important that any investor who's looking at an ETF make sure that they understand the individual characteristics of that ETF.
Absolutely. So it is worthwhile pointing out on Moomoo's app, we've seen what Michael was pointing out is inverse ETFs increasing in popularity, but more often than not, we've found that the winning trades are those taking a longer term view, as in that the S&P 500 would rise over time, and we've found that those typically have been the winning trades by Moomoo clients. Let's just change pace now to another question, and thank you for those of you who are sending in questions. How would the interest rate adjustment impact stock price or stock prices of financial institutions, cryptocurrencies, and related ETFs? Another question about ETFs. Double barrel question. Would it be timely with the latest job market statistics, ongoing trade wars, and upcoming elections? So I guess the question is more or less, how do interest rate adjustments impact financial institutions, cryptocurrencies, and related ETFs? That's the question. Let's go to you, Justin, for this one.
Yeah, so I guess there's a couple different questions in there, and let's talk about financial institutions first. And I think a lot of people are always thinking about rates going up or down, the long or front, the front or the long end of the curve, and how they're evaluating the net interest margin. But I think sometimes you lose the big picture, and a lot of these financial institutions, you're worried more about two things, and the first of them is some type of consistency. So they want to see this, the Fed cycle be on some type of consistent path. Maybe they kicked it off with 50, but this idea that they will cut 25 for a certain number of cuts until they get to the neutral rate, it makes the adjustments for financial institutions much easier. It smooths a lot of their earnings out. And so those are the types of things I would be looking for with a financial institution. What you don't want to see is these emergency 75 basis point rate cuts. People think, well, that's going to be good for the financial institution. That could cause a lot of consternation among a lot of people that have their deposits with these banks, and it could cause a lot of worry about, do I want to take a loan out if there's emergency rate cuts? And so while you think that could be good, but it might not be for these, and that's really where it goes into the economy. And so you really have to track the economy, because the issuance of loans, the use of credit, a lot of this relates back to how people are viewing the economy and how confident they are. On the cryptocurrency side, what have we seen crypto really be a proxy for recently is kind of this risk-on mentality. And so when we do see the more risky side and the more tech-forward side of the market do well, we've seen crypto do well. And so that's what I'll be watching for on that side. And again, it will really be, can the Fed engineer a soft landing? And you see those rates coming down, that could be very good for crypto. But it could be very bad for crypto if the reason they're cutting is because we're seeing, really a huge economic slowdown. And then as far as the ETFs, again, you've already explained what these ETFs are. These ETFs track, the underlying. So, on Moomoo, you can trade cryptocurrency ETFs that track the actual cryptocurrency. So you don't have to worry about getting, a Bitcoin wallet or anything like that. You can actually just trade the ETF. So in a lot of ways, it's easier for users to get in and out and have that exposure to crypto without actually being in the underlying. You could be in the ETF. And in terms of, the job market statistics and the wars and the election, I would basically say a lot of times two of those two out of those three are overblown in terms of market reaction, and that's war and election. And in general, people are worried because they're not sure of the outcome, but in the end run, it doesn't affect the companies that much in their earnings profile. Whether you have one candidate get elected or another candidate get elected, we've seen these Republicans and Democrats switch, and the companies continue to make money. So they continue to do well. So it doesn't affect the stock market as much as people think. There are small effects. There are certain sectors, but what really does affect it is the economy and these job statistics. And I think those are the most important thing to look at. When people don't have jobs, they're not out there spending money. And then you see an economic slowdown, and that's going to affect company earnings. And that's what you have to ultimately think about is what's going on big enough to affect the company earnings, and because that's what you're buying into when you buy a stock. You're buying into the future cash flows of that security.
Point well said. Worthwhile pointing out that markets historically go up when earnings are growing. So earnings growth, as I always say, earnings growth drives share price growth and earning revisions or earnings upgrades. And I guess it's pleasing to see that this morning, after the Federal Reserve cuts were announced and after they see GDP continuing, it was pleasing to see that consensus or the markets are now thinking that earnings estimates will grow a little bit more than they were expected to. So that should, for the most part, support share price growth over the long term for the broad market. Before we wrap up, I just want to go to, we've got 4 minutes to go. I just want to go to a very quick question now. Let's go to Michael for this final question. With supply and demand being equal, how would rate cuts affect energy and commodity markets? Really, really important question there.
It is an important question. And first of all, I'd like to point out that all things are never equal. Markets are unpredictable and they're organic in nature. And so that means that while we try and apply the science of numbers and mathematics to them, we're often left with some messy outcomes. But nonetheless, the impacts of supply and demand here in the commodity markets are very low, in my opinion. One of the factors, of course, is a weakening US dollar is generally supportive of commodity prices because as the dollar falls in relative terms, commodities like oil become more valuable. So we might think that that's supportive. Also, the fact that the Fed has moved to stimulate the US economy could be seen as a positive for energy markets. But it's interesting to note that the reaction in energy markets so far has been negative. And while we've certainly seen some what I would regard as sell the fact reactions in equity markets, oil markets are nearer lows than highs at the moment. So to see a negative reaction, and to see that negative reaction despite the fact that we've heard further news of military conflict in the Middle East, suggests that there might be ongoing weakness. And this is what Justin was alluding to earlier. There is a potential signal here that the economy is weaker than was thought. And the move in the Fed estimates of future GDP growth, of future unemployment rates, and of future inflation all deteriorated in their estimates released today. So some investors may focus, and it appears energy markets are certainly focusing on the fact that the Fed has signaled the economy is weaker than they were expecting. And for that reason, we could actually see pressure on energy markets coming out of a decision that on balance we would think would be stimulatory for the economy.
That was indeed a great summary. Just further to that, absolutely. It is also worthwhile pointing out that the Fed did say that they see unemployment or the jobless rate rising a little bit more than they previously expected. And that also, I guess, combines to the fact that we've seen that bigger than expected cut. But all in all, just wrapping up today, the Fed did cut rates by 0.5%. The market was only expecting that to be done to the tune, if we can say, the market was only expecting that move, or 67%. of the market had priced in that move. But for the most part, the Fed did map out about 2% of rate cuts over the coming year or so. That's more or less in line with estimates. Further to what Michael and Justin have said, they did downgrade GDP and also expect unemployment to pick up. But for the most part, our financial markets will probably, over the longer term, look at rate cuts being made for the first time in 4 years as a positive. But as Michael and Justin have said, we are seeing sell the news. But on behalf of Moomoo Australia, we thank you so much for joining us. And from Moomoo the US, we've got Justin Zacks, in our US team, VP of Market Strategy there. Justin, thank you so much for your time. And Michael McCarthy, Chief Commercial Officer in Australia, thank you so much. Please keep your questions coming on Moomoo's Learn Premium. And thank you so much for joining us.
Thank you.